A lot of people are going to lose money in real estate this year. It's unfortunate, and it's not due to the buildings being bad, but due to one thing that just wasn't really questioned at the time of funding and at the time of acquisition. But that one thing is going to make or break the capital outcomes for a lot of deals and a lot of investors in the next year or two. So first, let's just talk a little bit about why we even look at real estate, because it's hard to think for some type of asset class that has the potential to lose your money, why would we even participate at all? Well, real estate has built more durable wealth than probably any other private market vehicle in the entire planet. I mean, it does three things all at once that stocks don't do. One is it pays you to own it, oftentimes monthly. I'm talking cash flow from leases, and it pays down its own debt over time if you have an amortizing loan. It can be a phenomenal source of cash flow. Pair that with appreciation. And usually, by the way, those are modest gains of appreciation, but real estate is levered. Most real estate has debt behind it, and even a modest appreciation over time can create an absolute fortune due to leverage. And three is tax benefits. I'm talking about leveraging K1 pass-through deductions, big, beautiful bill bonus depreciation, cost segregation studies to flow through real tax benefits that even publicly traded REITs can't match. Oh, and by the way, there's a fourth thing too, and it's probably not what you think it is, but real estate is an illiquid asset, and that frustrates a lot of passive investors because they can't access their money. You know, it takes 3, 5, sometimes longer years to get your money back. However, Morningstar has actually done a report around the cost of panic selling. And I know we're all super unemotional investors, and we're analytical, and when the market drops 20%, we're not touching our swap accounts, right? But the reality of the matter is the data says, on average, people lose 1.2% a year due to panic selling behavior. Over a decade, we're talking about 15% of total return gone to behavioral tinkering, right? So that's something that actually locking up capital will remove. And think about the compound effect of what that return is over years and years and decades beyond that. So the asset class actually works. The problem is you can still lose money in it. Now here's why. So you've probably seen the headlines. A pretty well-known publicly facing sponsor just took a really heavy loss on a fund. I mean, they lost like $15 million of investor capital. And he's not gonna be the last one to do that this year. And if you own anything in real estate, or if you've been tracking the space, you're probably asking the question quietly, like, was this asset class actually as safe as what you were told or what you were sold? It's a really important question to marinate on. Now, let me give you a perspective that I carry from a past experience of mine. But I spent 10 plus years in venture-backed food tech before I built Ocean Ridge Capital. And I watched some of the smartest people I've ever met in my life lose everything from a single board meeting. Now, these people were not dumb. They were some of the most intelligent and capable people I've ever come across. And they had, every part of the package of degrees and stock options and everything. But the risk that took them out wasn't in the product. It wasn't in their employment. It was in the cap table of the company. It was the dilution clause. It was the liquidation preference of the venture-backed funding that they signed that completely wiped out their common stock in a down round. And the documents that decided their financial life were sitting in a folder, essentially trusted by somebody else to read them. So despite some of these founders building up net worths into the hundreds of millions of dollars, I watched overnight those come crashing down and those people essentially having pennies to their name. Now, the same thing is happening in real estate to passive investors right now. Maybe it's not to the magnitude of a founder who has their entire net worth in one company, but the same risk that's about to take people out isn't in the building. It's the debt terms that most of the investors never stop to question in the first place, because misread risk does not care how smart you are. So let me underscore again what I'm saying here. The blowups that are happening in real estate right now are not the real estate failing. They are a financial bet that was sold as passive income. That's the failure. That's the structural breakdown. And in 2021 and 2022, billions of short-term floating rate loans got written up across all sorts of commercial real estate. And the pitch was super simple. Rates are super low. Rents are climbing quickly. People are moving into different places. we're going to stabilize the building. We're going to refinance into long-term debt. We're going to make a lot of money in the process. Now, what ended up happening is that rates went up and rents flattened or even in some places declined. And those rate caps that actually protected the debt from increasing started to either expire or they never were purchased to begin with, because who needs a rate cap when the Fed fund rates are so low, right? Well, last year, nearly $1 trillion of commercial real estate loans came due, and a lot of them got pushed forward. Banks are playing an extend and pretend game, but another wave is coming this year, and multifamily is the single biggest piece of that wave. Now, multifamily loans coming due this year are running only at about 0.5% of delinquency, whereas office, for instance, is over 12%. So real estate isn't on fire. We have to separate the macro narrative, but a specific bet in real estate sure is. And that's the thing that investors are losing their money on. So what's the real risk in a real estate deal anyway? It's not the building, it's the capital structure, right? And the one question that very few investors take the time to understand is what happens to a deal if rates stay where they are and if rents do not grow. Can you imagine that? We don't live in a hyper-accelerated economy. Well, a lot of investors spend time poring over the projected returns and digging into all sorts of market study things, but they actually don't read the terms of the debt. They don't consider what happens in the supply pipeline, and they end up over-indexing on demand and under-indexing on supply without really understanding the implications of the debt. And that is the single fundamental breakdown that I've seen the most in this last cycle of translation. And investors that, are now caught off guard by the fact that things didn't work out the way the sponsor said they would. Now, add in political and tenant risk from some states, which is, a reason why a lot of people have left blue state investing. Add in environmental problems that, some of them you can insure against, but sometimes things happen. But the capital structure is, at the end of the day, the thing that's breaking down these deals. Now, let me show you what this kind of better way to do to look at deals going forward would be in practice. Now, a lot of the deals that I see look super clean on the cover page, right? They are in the best markets in the country. They can support supply growth, demand, job growth. They have a good basis and a good story, sponsors with real track records, all the above. And I will run some common filters across these deals, which will immediately kill about 99% of these deals. But the pattern that I see still being used is the use of short-term bridge debt and a rate cap that runs out before the business plan does, and a pro forma that needs rents to climb every single year. And so we'll screen just on that simple kind of paradigm of things. And I will basically ask the question to that sponsor: what happens if rates end up staying flat and if rents do not grow? And if their answer has to do with painting the upside case to be bigger than it was, or trying to redirect me, that deal is as good as dead. Because most of those deals, at least for me, I don't think they're going to pencil the way the sponsor says they are. And I would rather think, if our base case is we just continue with today's kind of environment, which is challenging, and draw it out 5 years, can this property still survive? Well, then any sort of rent growth beyond here and any sort of rates decreasing beyond here is actually going to be positive upside, and it's only going to help our case. Those are the kind of deals that I want to do. So here's the filter, and you can use it on any deal, including anything that Ocean Ridge puts out, by the way, because I would love for you to criticize and scrutinize and look at everything we have so that we can get better together at doing this. But before you read the projected return, read the debt. And 3 questions. 1, is the debt fixed or capped? And for how long? What's the duration? If it's expiring in 1 or 2 or 3 years, you're likely dealing with a relatively high risk deal, and at least ensure that that deal has a very high reward to it. Otherwise, you may be paying the price for something that has a higher probability of losing your capital when ultimately you might not realize that. Number 2 is, does the deal still cover its payment if rates stay where they are and rents don't grow at all for the next several years? That's a really key one, because a lot of sponsors come in and do value add work, but the reality is, if they are in an oversupplied market and there are lots of other options for tenants to choose from, they likely won't be able to increase rents substantially. They're going to need to keep that property afloat where it is. And that's a really key point of the longevity and staying power of that deal. And then number 3, when does the loan come due? And will you be forced to refinance in a market that you ultimately might not be able to predict? Now, most of these commercial loans I mean, maybe you can max them out at 7 or 10 years. Oftentimes they adjust midway through the cycle, but at the very least, try to find somewhat of a bias towards longer term debt. It'll expand your runway and your ability to have more options. And if the sponsor can't answer these questions cleanly enough, the return number, it's probably fiction, to be honest with you. So those are really good telltale signs that we like to use that really tell us not just about the deal, but about how the sponsor underwrites their entire universe of deals and whether we want to work with them or not. So to sum up, the investors losing money in real estate this year are not unlucky per se. They just funded a deal where nobody could answer those 3 questions, deals where they didn't fully understand the risk profile, or they took a calculated bet and they saw that this could have been a realistic case. But I find that the latter is not very common amongst limited partners that have invested. The ones that are doing well did read the debt before they read the return. They did scrutinize the deal. And that's really the only difference I'm seeing. So if you are thinking about putting capital into real estate this year, and again, with all of the benefits that we have, from cash flow to debt pay down to appreciation to tax benefits, this can be a great asset class. We just have to understand the risks behind it. We pulled together a small quiz, takes about 2 minutes to do it. It's on oceanridgecap.com/quiz, and it'll actually help you see what kind of investor you are and how to position relative to the types of goals you have and the universe of opportunities in real estate. So I would love to hear your take on this video. Let me know any other topics you might want me to cover, and we'll see you next time.